Walmart meeting estimates. It has been a big day for retail earnings. You heard about Walmart from Scarlett. Earlier, Home Depot actually beat analyst estimates. Walmart, however, also raising guidance. For more, we are joined by Joe Feldman of independent research and consulting from Telsey Advisory Group. Telsey focuses on retail and has received top rankings from Institutional Investor. Joe, I'm looking at both these companies, Walmart and Home Depot, and noticing a trend, one we've seen for several quarters, and it just keeps on going, margin improvement. They're not doing that great on the top line, but the bottom line continues to get better. And in the case of Walmart, they're raising guidance for earnings per share, but the sales guidance remains unchanged. Translation, margin improvement. How's it happening?
Well, there's just such efficient operators. I mean, everything from the supply chain to the way they manage their expenses and manage the labor in the stores, they are the best at it. I mean, they're very, very efficient. You saw it with Home Depot as well, and really you're seeing it across retail. But at the top of the pyramid is certainly Walmart in terms of expense management and really driving profit to the bottom line.
Well, every quarter, it seems, we ask the question, for how much longer can it continue? And theoretically, it has to stop at some point. Well, look, let's look at the stock for a moment. I guess the stock tells you everything that investors are feeling right now. It's only up 1%, maybe getting a bit of a kick today. So less than 2% on the year. Is that telling you that investors need to see some revenue growth or more aggressive revenue growth from Walmart before they feel better about its longer-term prospects?
That's absolutely right. I think investors really want to see the top line, and I think people are encouraged by the fact that the company raised the guidance today, and they're still sticking with the same-store sales, expectations people had heading into the fourth quarter. Assuming they can get to a positive same-store sales level, I think that stock's really going to start to work a little bit better, and it's going to push higher. And I think it's a reflection of that. Really, across retail, investors want to see sales at this point, and I think next year is going to be about top line more so than the margins this year.
What is your expectation? Do you think we can see that same-store sales improvement in the fourth quarter? Because it has, been 6 quarters that Walmart's same-store sales have declined?
We do. We're actually modeling a slightly positive comp. We're up almost a percentage point in the fourth quarter for Walmart. We do think that they're always well positioned for holiday. We think the trends will hold up okay. The comparisons certainly are easier, and so that will help as well. But we are at a positive comp, and then they'll be facing easy comparisons as you head into next year.
Now, how about Home Depot before we go? Let's take a look at this stock. Doing so much better than Lowe's, up 8.5% this year. Their main rival down almost as much. So there's a 17% gap between the two in terms of stock performance. Can Home Depot, keep it up?
Well, on balance, Home Depot has been outperforming Lowe's on the top line. As an example, today they reported a 1.4% same-store sales number. Yesterday was 0.2% at Lowe's. Right there it is, because they both are operating well. They're both managing the margins and expense lines very well. But it's the sales, and Home Depot's getting a bit more right now and has been much of this year. Home Depot also has some other initiatives in place. This supply chain initiative and investing in information technology that's helping to drive more investor interest in that stock.
Joe, we thank you for joining us on the conversation about Home Depot and Walmart. Joe Feldman of the Telsey Advisory Group.